So guys, our next question should be question number 44. This is a question which is based on lease payments which are to be made in foreign currency. So your lease liability and all by default will be in foreign currency terms. Of course, you will have to account it in our own functional currency, which is rupees in this case. But this particular question is more or less similar to a foreign currency loan what we have accounted under Ind As 21. So if you remember that concept, this is as good as, we need not do anything specifically here, but although for whatever worth it is, we'll try to solve this. Entity X is an Indian entity whose functional currency is Indian rupee. It has taken a plant on lease from Y for 5 years to use in its manufacturing process, for which it has to pay annual rentals in arrears of $10,000 every year. That means our entity is an Indian entity whose functional currency is rupee, but we have taken lease of a particular plant and machinery. Rents are payable in US dollars. On the commencement date, exchange rate was 68 rupees. The average rate for first year was 69, and at the end of the year the exchange rate was 70. The incremental borrowing rate on entity X on commencement of the lease for a US dollar borrowing was 5% per annum. Okay, how will entity X measure the ROU asset and lease liability initially and also at the end of the year? Now, as you can see here, when you are standing on the commencement date, every year you have to pay an amount of $10,000. Like that you have to pay for a period of 5 years. So $10,000, do not convert it first, keep that in foreign currency only and use your discounting rate, convert everything into present value. The present value of 10,000 what you have to pay over a period of 5 years as on today is $43,300. If $43,300 into what is the spot exchange rate, 68, when you multiply with that, you will get 29,44,400. So this fellow has done a big table and he's converted each number. You need not do that. You can normally work out an annuity factor, multiply with 10,000. So basically your number will be 10,000 into PVIFA 5% for 5 years. This entirely is present value of lease rents in dollar terms. This multiplied with 68 rupees will directly give you rupees 29,44,400. This is your initial recognition of lease liability amount. So the first day accounting is done. Now coming to end of the year accounting. Now end of the year accounting, ROE asset means simply provide depreciation, there is nothing great, and that too ROE asset is a non-monetary item, there is no further restatement for that. But the lease liability is to be measured under amortized cost method. So when you apply ACM now, for lease liability, first year, opening balance. The only mistake you should not do here is when you prepare ACM table, that ACM table should be in foreign currency, not in your functional currency. That's the only mistake you should try to avoid. Rest all is okay. So that should be 43,300. To this add interest expense at the rate of 5%. That is 2165. Minus cash flows paid, that is the lease rents paid in the first year, that is $10,000. So that is 35,465. This is your closing balance. This entire thing is in dollars. This in rupee terms you already recorded at rupees 29,44,000 some number 400. Interest you are still to account because interest accounting will happen at the end of the year. Cash flow is also paid at the end of the year. Closing balance is a monetary item, so that remeasurement also will happen at the end of the year. That will definitely give you an exchange gain or exchange loss, which will travel to PRL. Anyway, let's see. Interest expense, account debit to lease liability. That's $2165 into, I think the question has given to you an average rate for the year, which is 69 rupees. 69 is an average rate, so multiply with rupees 69. So 2165 into 69, that is 149,385. So lease liability account debit to bank, you are paying an amount of $10,000 at the end of the year. So this is an initial recognition of transaction, so that should be 7 lakh rupees. At this stage, balance in lease liability account will be equal to that is equal to 23,93,785 rupees. Lease liability is a foreign currency monetary item which is remeasured at closing exchange rate of rupees 70 per dollar will be equal to 35,465 should be multiplied with 70 rupees per dollar, so that will give you 24,82,550 rupees. Therefore, increase in lease liability, or you can actually call it as exchange loss on remeasurement, is equal to 24,82,550 minus 23,93,785. That is 88,765 rupees. So for this, if you want an entry, that should be exchange loss account debit, of course PRL, to lease liability account. I guess only that much, sir. Yes, sir. You can see here exchange loss of 88,765, and of course one more point, that is the depreciation on ROU asset, 29,44,400 rupees divided by 5 years lease we have taken, so per annum it should be 5,88,880. So for that also, if you write an entry, depreciation account debit to ROU asset 588,880. Very ordinary sum, very simple sum. The only thing you should remember, in fact this type of question was there in Ind As 21 also, the only thing you should not make a mistake is this particular ACM table you should make in foreign currency terms. That one, if you do it, rest of the sum will normally fall in the flow. I hope this is easy for you. Let's move on to the next question. Question number 45. Question number 45 is a very, very basic level question. You can handle this on your own, although I'll just go through it for you. Entity X, the lessee, entered into a lease agreement with entity Y to lease an entire floor of a shopping mall for a period of 9 years. The monthly lease rent is 70,000 rupees. To carry out its operations smoothly, entity X simultaneously entered into another agreement, which is a facilities agreement with entity Y for using certain other facilities owned by Y, such as passenger lift, DG sets, generator sets, power supply infrastructure, parking space, etc., which are specifically mentioned in the agreement for a monthly service charges amounting to 1 lakh rupees. As per the agreement, the ownership of the facilities shall remain with entity Y. Lessee incremental borrowing rate is 10%. Now, if you observe closely here, the lessee, Mr. X Limited, has entered into a lease agreement. Apart from lease agreement, there is another agreement with Y where they are taking some facilities also. So, one is for lease of an asset of there is a particular floor which they are taking in a shopping mall. For that, anyway, rents will be paid. Apart from that, there are some other services also which Y is providing to X, like power, DG backup sets, usage of lift, car parking space and all. For these also X is paying some amount, which is 1 lakh according to the contract. That means indirectly what should strike in your mind is there is a lease component, there is a services component which is called as a non-lease component. Both exist in our contract. The facilities agreement clearly specified that it shall be coexistence and co-terminus with lease agreement. The facility agreement shall stand terminated automatically on termination or expiry of lease agreement. Entity X has assessed that the standalone price of lease agreement is 1,20,000 per month and standalone price of facilities agreement is 80,000 per month. Now, if you watch correctly, the lease, non-lease, lease component ka standalone price is 1,20,000 and this one is 80,000. But in the contract, what you people have entered is contract price. You have taken this as 70,000. Non-lease facilities you have taken an amount of 1 lakh. Overall, there is a discount because 120 plus 80 should be 2 lakhs. But you are paying to the supplier only an amount of 1,70,000. Definitely there is a discount. But we cannot accept the contract values because there is a lease and a non-lease component. The total consideration must be apportioned between lease and non-lease component in the ratio of the standalone selling prices, and these are your standalone selling prices. So what you must do is 1,70,000 rupees you must allocate it in the ratio of standalone selling prices first. Entity X has elected to apply has not elected to apply the practical expedient of paragraph 15 of Ind As 116 of not to separate the non-lease component from the lease component, and accordingly it separates non-lease components from lease components. What he is indirectly saying is, see, Ind As 115 for the lessee has given one option. What is that option? Even though there is a non-lease component, you can ignore that. You can club along that also with the lease agreement and treat entire 1,70,000 as a lease payment itself. That is a practical expedient that is available to the lessee. But this Samlu lessee is not availing that option, which means that he wants you to treat the non-lease component separately and not to mix up that with the lease component. So fine, what is there? Total 1,70,000 is the amount what you are paying. If 1,70,000, first you split it in the ratio of 120:80 so that you will know the correct lease rent or correct amount which ideally you are paying towards lease rent. So when you split like that, it's working out as 1,02,000 and 68,000. So totally your 170 split into 102 and 68. 102 is the lease payment, and this is for the non-lease component or for the services what you are obtaining. So every year, as and when you obtain service, automatically the cost will be booked off into PRL account. Or 68,000, there is no specific accounting treatment. You simply have to book it as an expense in your P&L account each year. But 1,02,000, since it becomes or qualifies to be a lease payment, definitely it will go into calculation of lease liability. So obviously you have to discount next 9 years ka lease rents, 102, 102, 102, multiply with PV factors, you got 587,316. So with this amount, you will go and recognize the ROE asset and lease liability. That's it, sir. Question number 46 is a question which is based on manufacturer lessor. Similar question which we have already covered, the same question, sir. In fact, there is nothing change also. Company manufactures specialized machinery, the same sum. This will come in a while. Come to question number 48. So let's move on to question number 48. Okay, wait a minute, and erase this so that it will be easy for you to focus. Okay, Feel Fresh Limited is into manufacturing and retailing of FMCG products listed on stock exchanges in India. One of its products is bathing soap, which the company sells under the brand name Feel Fresh. The company does not have its own manufacturing facilities for soap, and therefore it enters into arrangements with the third parties to procure the soaps. The company entered into a long-term purchase contract of 10 years with Messrs. Radhe. Following are the relevant terms of the contract with Messrs. Radhe. Messrs. Radhe has to purchase a machine costing 10 lakh rupees from the supplier as specified by the company. Okay, so our company name is Feel Fresh Limited. So our company has no manufacturing facilities on its own. So it has entered into a contract with Messrs. Radhe. Radhe has to purchase a machine costing 10 lakh rupees from the supplier as specified by the company. So Radhe, whoever is a manufacturer of the soap, he has to buy the machine from that supplier whom we identify. So Feel Fresh will tell which machine Radhe has to buy, and the machine will be customized to produce the soaps as designed by the company. So machine will be customized. The machine cannot be used by Messrs. Radhe to produce the soaps for buyers other than the company due to design specifications. Indirectly what he is saying, whatever machine Radhe buys to manufacture soap, that machine cannot be used by Radhe for producing or manufacturing soaps relating to other suppliers. Indirectly, a machine must be used only for the purpose of manufacturing soaps relating to our company only, Feel Fresh. Then the machine has a life of 10 years and straight line method of depreciation is best suited considering the usage of the machine. Second point, the company will pay rupees 4.75 per soap for the first year of contract. This is calculated based on annual purchase of 7 lakh soaps as follows. So for every soap what I buy, I have to pay an amount of 4.75 rupees, assuming that we are buying for 7 lakh soaps. He is giving you some cost breakup. Means a 4.75, how he has derived, he is explaining. Variable cost of manufacturing, that is 4 rupees per unit. Cost of machine 174,015 divided by 7 lakh soaps 0.25. Now what is this? He is explaining that in the third point. We will discuss that, nothing to worry. Radhe will expect some margin, he is a manufacturer, so 0.5 for that. And per soap cost is 4.75. Story does not get over. Continue. In case the company purchases more than 7 lakh soaps in the first year, then the cost of the machine, that is the 0.25 per soap, whatever is there, no, that one will not be paid for soaps procured in excess of 7 lakh units. Okay. However, in case the company procures less than the budgeted number of soaps, then the company will pay the differential unabsorbed cost of the machine at the end of the year. For example, the company purchases only 6 lakh soaps in the first year, then the differential amount of rupees 24,015 will be paid by the company to Radhe at the end of the year. Variable cost will be actualized at the end of the year. Variable, okay, that's double printed. Nothing, sir. What he is trying to say here is, if you buy exactly 7 lakh units from the supplier, so supplier you have to pay 4.75 rupees per unit and nothing more. In case your requirement goes beyond 7 lakhs, let us say you buy 8 lakh units, then if your actual purchase is 8 lakh units, out of this for 7 lakh units or 7 lakh soaps, this price is applicable. For the remainder 1 lakh rupee, 1 lakh soaps whatever you are buying, for that he will not charge you this 0.25, that won't be there. So you will be paying only 4.50. That means the cost of the machine 174,015 whatever divided by 7 lakh soaps, which is 0.25 per unit, he will charge you only up to 7 lakh units. Beyond 7 lakh units, if you buy also, you will not be paying this 0.25. Similarly, contrarily, he says that if you buy only 6 lakh units, if you buy only 6 lakh units, then 6 lakh units he would charge how much? 4.75. That anyway you will pay. Apart from that, what he could not recover from you, you see, every year that fellow wants to recover from you 174,015. If you buy 7 lakh soaps, then 7 lakhs into 0.25 will work out. But if you are buying more than 7 lakh units, then he will not charge you anything more of that 0.25 per unit, indicating that he does not want to recover from you more than 174,015. But in case you buy less than 7 lakhs, let's say you buy only 6 lakh units, and 6 lakhs into 0.25 means a 4 points only 0.25 is included, no? So that will work out to only 1,50,000. But actually he has to recover from you how much? 174,015 per annum. No, how did that number come? Don't worry, we'll discuss that later on. He has to recover from you 174,015, but in the form of 4.75 you already collected 1,50,000. Then the extra balance amount 24,015, that you have to anyway pay. Indirectly, what you must understand from this is in substance lease payment, in substance fixed payment. Your lease payment definition includes fixed payments and in substance fixed payments. This is an in substance fixed payment. So how is this an in substance fixed payment? Imagine you exactly buy 7 lakh units, then he is recovering from you 7 lakhs into 0.25. Of course, a 4.75, 0.25 is included. If you buy more than 7 lakh units, then he is not recovering that 0.25. That means up to 7 lakhs he will charge 0.25. No, in that 174,015 you are anyway paying. More than 7 lakhs if you buy, he is not collecting. If less than 7 lakhs you buy, in that case, for example 6 lakh units only you buy, you will be anyway paying 1,50,000. At 24,000 also he is collecting. Moral of the story is, irrespective of the number of units you are buying, effectively you end up paying to the supplier 174,015 rupees. This is an in substance fixed payment. Third point is all about he explaining you how he worked out that 174,015. It's a very simple one. Go and read. The cost per soap will be calculated for each year in advance based on the budgeted number of soaps to be produced each year. An amount of rupees 174,015 shall be considered each year for the cost of the machine for the year 1 to year 8 while calculating the cost per soap. Any differential underabsorbed amount shall be paid by company to Messrs. Radhe at the end of that year. That is what we have discussed earlier. A charge of 174,015 per annum for the machine is derived using the borrowing cost of 8% per annum. For year 9 and 10, only variable cost and margins will be paid. What he is trying to say is 10 lakh rupees, whatever cost of the machine is there. No, sir, that cost he will recover it over a period of 8 years. I understand the arrangement is for 10 years because the machine life is also 10 years, but he wants to recover this entire 10 lakhs cost over a period of 8 years only. So what is there? So we'll do 10 lakhs divided by 8 years. Not like that. He considered time value of money also. So when you consider time value of money also, including interest, you have to recover the installment. So this will become something like you working out equated annual installment in case of a borrowing. Let's say you borrowed an amount of 10 lakh rupees, which is to be recovered over a period of, which is to be repaid over a period of 8 years. Considering interest rate is 8%, PVIFA 8% for 8 years. If you work out this, 10 lakhs divided by, I already worked out 5.7466. So that should be equal to this number, whatever we have worked out. So 10 lakhs divided by 5.7466. So that's 174,015.94. Just making it to. So this is how he has gotten that. Anyway, continue. Messrs. Radhe does not have any right to terminate the contract. That means the supplier cannot close the contract, but the company has a right to terminate the contract at the end of each year. However, if the company terminates the contract, it has to compensate Messrs. Radhe for unabsorbed cost of the machine. See, sir, supplier has purchased a machine. Supplier has purchased a machine at our behest. We asked him to buy a particular machine. The machine life is 10 years. Our contract also ideally should be for 10 years. But he says that if we want, we can terminate the contract any time. But in case you do that, for example, after 1 year or after 2 years, if you terminate the contract, whatever unabsorbed cost of the machine which Mrs. Radhe has incurred, that you have to repay to Radhe. However, if the company terminates the contract, it has to compensate Radhe for unabsorbed cost of the machine. For example, if the company terminates the contract at the end of second year, it has to pay 10,44,090, that is 174,015, whatever you calculated, into 6 years, because for 2 years anyway would have paid, remaining 6 years also have to repay. If it terminates the contract after 8th year, the company does not have to pay the compensation since the cost of the machine would have been absorbed. A particular paragraph indicates that the chance of terminating the contract is less or less likely. Why it is less likely is, if I terminate also have to pay 174,015 per annum. If I don't terminate also have to anyway pay 174,015 per annum. So it is better to not terminate and continue the contract. And if you don't want to buy goods, don't buy each year. But still you have to pay 174,015, that much you pay. In the first year, the company purchases 5,50,000 soaps only at 4.75 per soap. Okay. Evaluate the contract of the company with Messrs. Radhe and provide necessary entries for the first year, and assume that all the cash flows occur at the end of the year. So anyway, sir, despite this much of big story that's given in the question, you must understand one thing. This is a lease contract that is inbuilt along with a supply of goods arrangement. So all you have to see is, first you have to establish in your solution that there is a lease that is contained in your contract. Now how will you establish that there is a lease contained in your contract? Lease definition is, what is that? You must establish that there is an identified asset. You must establish that we have right to control the use of such identified asset, and you must identify the consideration, which is nothing but the lease payments, which is in substance fixed payment of 174,015. So all the points of your identified asset, all the points of right to control the usage of the asset, all these points you have to quote and link it to the question. Very, very simple question. You can look at all the points. Now, Radhe has to buy a customized machine as per the directions of Feel Fresh Limited, and machine also cannot be used for any other type of soap except for our benefits. So therefore, very clearly there is an asset identified. Which asset they have to buy, I have decided already. That asset only they must buy. So there is an identified asset. Next. Right to control the usage of identified asset. Further 2 points are there. What are the 2 points? Substantially all the economic benefits relating to usage of the asset should belong to lessee only. Number 2, decision making power also we should have. Machine cannot be used for manufacture of soap by any other buyer. Feel Fresh Limited will obtain substantially all the economic benefits from the usage of the asset throughout the period of usage. So that benefits are also substantially belonging to us. And we control the usage of the machine. That is anyway there. So the contract contains a lease. Ultimately, you first have to establish this. Then, regarding lease term. Now, lease term, how much is a lease term? Because the machine life is 10 years. The machine itself is purchased based on our identification, our specification. So, ideally the lease term should be 10 years. The other fellow does not have a right to cancel the contract, but we have a right to cancel the contract. But even if I have a right to cancel the contract, I still have to pay the lease rent for the remaining period, that is the in substance fixed payment. So in the absence of any other information, we are assuming that the lease term is going to be 10 years, assuming reasonable certainty. Assumption that is. Next, you have to establish the lease payment. So first for that you have to write the lease payment definition. Lease payment includes fixed payments along with in substance fixed payments, variable payments, guaranteed residual. All these definitions are the entire definition you quote and prove that 174,015 is an in substance fixed payment. So 174,015 you have to pay over a period of 8 years, discounted at the rate of 8%. If you discount, that is working out to approximately 10 lakh rupees only. Sir, what if I buy more units than 7 lakhs? If you buy more units than 7 lakhs, then you will be paying something more than 174,015. Means whatever you pay extra other than this 174,015, that is non-lease component. No, sir, that is for purchase of goods. So that other than 174,015, whatever you pay, that's a non-lease component. That's the cost of buying the soap. That should be debited to your P&L account as expenditure directly. Only the 174,015 must be used for your lease payment. That's also, this is absolutely simple question. So on the very first day, what accounting will you do? You will have to first day as usual ROE asset account debit to lease liability with an amount of 10 lakhs. If 10 lakhs is nothing but this is the present value of 174,015 discounted at the rate of 8% per annum for 8 years. Sir, you did not discount and show us. Hare sir, 174,015 itself is computed by taking 10 lakhs as the base. So again, if you multiply 174,015 with 5.74666, what will you get? You will again get 10 lakhs only, no? So the same stuff again, okay? Then as usual, sir, normal entry, interest expense account debit to lease liability account debit to bank, depreciation to ROE asset. That's all. This one is also important. 5,50,000 soaps you purchased in the current year by paying 4.75 rupees per unit. In that 4.75, 0.25 is lease payment. Barring that 0.25, remaining 4.5, whatever you are paying, there's a normal expenditure in your P&L account. So there you go. So question number 49 we have already solved. It's a basic question on finance lease, and then it's also there in CA intro also. Question number 50. Case 1 again, scenario 1. The last mile is a dedicated cable that connects entity Y's network with end customer's device. Okay. The use of this cable is at the discretion of the customer. So there is a cable which Y is supplying with the customer. Y is supplying to the customer. The use of this cable is at the discretion of the customers. Entity Y decides the location of end points and has the right to replace the lines. However, it is not practical to replace the lines since replacement would require additional cost to be incurred without any corresponding benefit. Whether the arrangement would be within the scope of Ind As 116. Sir, if there has to be an identified asset, then the substitution rights of the supplier should not be substantive. That's what we have learnt. And when will you call them as substantive? When he has practical ability to substitute, plus because of that substitution, he should be able to derive some benefit economically. But in this question, he is very clearly stating that that fellow does not have any practical ability because the cost of replacement will be very high and he would not be getting any benefit because of replacement. So even though technically he has a right to substitute, that right to substitute is not substantive. Since it is not substantive, there is an identified asset. Scenario 1. Coming to scenario 2 now. If it is practicable for entity Y to replace the lines, and entity Y would benefit from this replacement, would the answer be different? The answer is yes, because if the Y has the ability to replace the lines, means practical ability is there and benefit also is there, then definitely the substitution rights now become substantive and therefore there is no identified asset. Case 2. Customer X enters into a 10 years contract with an utility company Y for the right to use 3 specified physically distinct fibers within a large cable connecting Mumbai to Delhi. So X enters into a 10 years contract, 3 specified physically distinct fibers. Customer makes the decisions about the use of the fibers by connecting each end of the fibers to its electronic equipment. Entity Y owns extra fibers but can substitute those for customer's fibers only for reason of repairs, maintenance or malfunctioning. The useful life of the fiber is 15 years. Whether this arrangement is covered under Ind As 116? The answer is yes, because even though multiple fibers are there, this fellow is taking contract only for 3 physically distinct fibers and the customer only makes the decision about use of these fibers. So there is an identified asset, a right to control the use also is there, definitely there is a lease contract. Next one. Customer X enters into a 10 years contract with entity Y for the right to use a specified amount of capacity within a cable connecting to Mumbai to Delhi. The specified amount is equivalent to customer X having the use of full capacity of 3 fiber strands within the cable. The cable contains multiple fibers within similar capacities. Entity Y makes the decision about transmission of data. That means X is the customer, Y is the supplier. He will use a certain capacity. So how much capacity he wouldn't say, specified amount of capacity, but it is specified, and that capacity will be full capacity of 3 fiber strands. 3 fiber capacity he will use, but the cable contains multiple fibers. with similar capacities. Among so many cables, this fellow is using a capacity which is specified, but that is only 3 units of capacity or 3 fibers capacity among multiple fibers. Why makes the decisions about transmission of data? The useful life of the fiber is 15 years. Whether this arrangement is covered under Ind As 116, apparently it is not look like it is covering, because which 3 fibers he is going to use, that is not specified. He said that he'll use some capacity which is equivalent to capacity of 3 full fibers, but which 3 fibers, not identified. Physically it is not distinct. Moreover, if it is not physically distinct also, an identified asset can exist if the contract is to obtain substantially all of the capacity, which is not in this case, because among multiple fibers, 3 fibers only is taken. Moreover, entity Y is making all the decision making. So right to direct the usage of the asset also customer X does not have. Therefore, there is no lease contract. Not within the scope of Ind As 116. So guys, come to question 51. This is also an MTP question, easy one. The company has taken, the company means here actually, company name is New Age Technologies. The company has taken a particular application software of a supplier, namely Crystal Systems Limited, which is available on a cloud infrastructure managed and controlled by Crystal Systems Limited. Okay, so I have taken a software usage from some Crystal Limited. Software is available on a cloud which is managed and controlled by Crystal only. The company contracts to pay a fees of rupees 5 lakhs per month in exchange for a right to receive access to Crystal Systems Limited software for 2 years. The company accesses the software on need basis over the internet. The contract does not convey any rights to New Age Technology Limited over the tangible assets of Crystal Systems Limited. Okay, the chief accountant of the New Age Technology Limited has sought your advice whether it should account of this transaction for use of software with Crystal Systems Limited in terms of 116 leases or in terms of Ind As 38 intangible assets. Help him understand your assessment. See guys, our company New Age has contracted to use software which belongs to Crystal Systems Limited. This cannot come into the scope of Ind As 38, because if it has to come into the scope of Ind As 38, there should be an identifiability asset, because identifiability criteria is there in Ind As 38 also. And next one, you should be in a position to control the asset. Here very clearly New Age Limited cannot control this asset, because the question is amply clear that it's managed and controlled by Crystal Systems Limited. When you do not have power to control a resource, how can you call it as your intangible asset? You cannot call it as your intangible asset. Moreover, a software life can be so much, but you have taken this contract only for a period of 2 years. So substantial benefits from the usage of the asset you are not getting, and moreover you are not having any control over the resource. Therefore definitely Ind As 38 will not apply for you. And coming to Ind As 116, again the same problem comes. When it comes to Ind As 116, there should be an identified asset. Okay, fine, asset is identified, but what's the other one? Right to control the usage of identified asset. Where is the right to control the usage point gets satisfied when 2 points are satisfied? What are the 2 points? 1, substantially all benefits from the asset should belong to us. Number 2, we should have right to direct the usage. So here the second part is missing because we don't have right to direct the usage. Only it is managed and controlled by Crystal Systems Limited. Of course, we have a right to access it. Access is different from controlling it. Access means you are allowed to use, but it's not only you are using. There can be other parties also that can be having access to this software. And the main asset functionality is under the control of Crystal Systems Limited and not in the customer's hands. So the contract gives New Age Limited only the right to access the Crystal Limited's software over the contract term, and hence the contract is not a lease contract with the meaning of 116. That means it is neither Ind As 38 nor Ind As 116. So where will it fall into? It will not fall into anywhere. Whatever you are paying for usage of the services will be booked as an expenditure in your P&L account. That's it. Next one, question number 52, a simple one, sir. The company has entered into a lease agreement for its retail store as on 1st April 2011 for a period of 10 years. A lease rent of 56,000 rupees per annum is payable in arrears. The company recognized a lease liability of some 3,51,000 at inception using a borrowing rate of 9.5% per annum. Okay. So 10 years lease, first day lease liability value they have given, every year you are paying an amount of 56,000. As on 1st April 2011, okay, that is not dot, sir. Okay, as per the terms of the lease agreement, the lease rent should be adjusted every 2 years to give effect of inflation. Fine. Inflation cost index as notified by income tax department shall be used to derive the lease payments. Inflation cost index was 280 for the financial year 11-12 and 301 for the financial year 13-14. The current borrowing rate is 8% per annum. Show the journal entry at the beginning of year 3 to account for change in lease. So this is a simple question that is based on variable lease payments. Now, when you started the lease contract, very first day, 0, 1, 2, 3, 4, up to 10 years, your first day, the index was 280 and your lease rent based on that will be 56,000. Third year, fourth year, lease rent will be different because lease rent has to be updated based on inflation index too. But what would be the inflation index at the end of second year or at the beginning of third year, we wouldn't know today, and you are not allowed to predict also. What did our standard say? Do not predict anything. Whatever is the index that is there on 0 time, that is commencement date, use that only and consider the lease payments accordingly. So first day index is 280, so 280 it is 56,000. So for all the years you will take only 56,000 only and continue. Accordingly only we did measurement. Accordingly only we got this 351,613. Like that accounting we have done for 2 years. Now I am standing at the end of second year or at the beginning of third year. At the beginning of third year, I came to know that the latest index is 301. So what you have to do now? You have to update your lease rents. Now, if I am standing at the end of year 2 or beginning of year 3, so this is second year ending or third year beginning, third year ending, fourth year ending, fifth year ending, sixth year ending, seventh year, eighth year ending, ninth year ending, 10th year ending. Here onwards my lease payments will be 56,000. If it was for an index of 280, for 301, how much is it? That I am copying from the solution only, 60,200. So what you have to do is consider 60,200 for all the years. I know 5th year, 6th year lease rent will be different. At that time again we will remeasure. So consider 60,200 and remeasure your lease liability. Again remeasure your lease liability. So all the 60,200 for the remaining 8 years discounted using your original rate. What is your original rate? 9.5%. Remeasurement, should I use the old rate or new discounting rate? Remember sir, when there is a change in the lease term or when there is a reassessment of option to buy or not buy, in that case alone new rate you have to use. In all other cases you have to continue with the existing discounting rate only. Of course if it is a modification, again you will go for a new rate, but reassessment of variable lease rents or index updation and all, you should continue with your existing rate only. So 8% whatever they have given in the question, that is a trap, do not touch that. So all you have to do is 60,200 remaining 8 years cash flows whatever are there, discount it using your original discounting rate of 9.5%. So when he does that, you are getting an amount of 327,092. So that's it. 327,092 should be your lease liability value at the beginning of third year. So as on today, how much it is? So he prepared an ACM table. By the end of second year or by the beginning of third year, book value is 304,273. So from 304,273, update yourself to 327,092. So correspondingly impact the ROU set. Very, very easy case, very, very simple case. Okay guys, come to question number 47. How will entity Y account for the incentive in the following scenarios? So guys, this question you can mark it important. Easy only, but mark it important because this is lease incentive accounting from lessor's perspective. Scenario A. Entity Y, the lessor, enters into an operating lease of property with entity X, the lessee, for 5 years term at a monthly rental of 1,10,000. In order to induce entity X to enter into the lease, entity Y provides rupees 6 lakhs to entity X at lease commencement for lessee improvements, that is lessee assets. Indirectly means he's asking how will you account for this? No, so that is how will Y account for this? So in this, see guys, as a lessor in an operating lease, whatever lease income comes every month, that automatically will become your income in your P&L account, correct? Now, apart from receiving monthly income in the form of lease rents, first day only you paid an amount of 6 lakh rupees to the lessee. So this is a kind of an expenditure you are incurring on day one, but the benefit for this you are going to receive over a period of 60 months. So the expenditure of 6 lakhs, whatever you spent on first day, should be treated as a deferred revenue expenditure, should be booked off to your P&L account over the period of lease. Accordingly, what will happen is there will be a matching between lease income and the lease incentive cost what you have incurred on day one. So effectively your entry should be deferred lease incentive expenses account debit to bank. So an amount of 6 lakh rupees, 6 lakh rupees is what you have recorded. At end of first month, you received some lease rent, no, first month. So bank account debit, what was your lease rent value? 1,10,000. So it's like this, sir. 1,10,000 and 10,000 is again recovering of whatever cost you spent. So effectively your lease rent is 6 lakhs. 1 lakh. Of course, you can write separately also. Bank account debit to lease rent income 1,10,000 plus incentive deferred cost, whatever is there, that will book it off to PRL over a period of 60 months. So rent account debit to deferred lease incentive expense. So that is 6 lakhs upon 60 months. So each month 10,000. So which means effectively lease rent income per month is equal to 1,10,000 minus 10,000, that is equal to 1 lakh rupees. There is another question. Scenario B. Entity Y enters into an operating lease of property with entity X for a 5 years term, monthly rent 1,10,000. At lease commencement, Y provides 6 lakhs to entity X for leasehold improvements Okay, which will be owned by entity by. Here there is a difference, sir. And the useful life of leasehold improvement is 5 years. Okay, fine. So what is the difference between A and B is, in A scenario, you are giving 6 lakh rupees to the lessee so that he will spend that money on improving his assets, because he has to migrate from one place to another place. But in the second case, the amount what you are paying to the lessee will result into improvement of our own asset. Let's say he is doing some modification to the building by making some additions and all. Because of that, ultimately a benefit retains with us only. Means it is resulting into enhancement of asset that belongs to the lessor himself. So this is not to be treated as a deferred expenditure or a lease incentive. Rather, it must be treated as your addition to your asset. So here your own asset ka value is increasing. Ideally, that's what they should have done. You can see here. So anyway, scenario A, B, no, let's change it as A. So scenario B, payment of rupees 6 lakhs results into enhancement of own asset of lessor with a life of 5 years. Therefore, amount is to be capitalized. So PP account debit to bank. Which asset exactly is getting improved? Data is not given. Most probably the building which is given on rent. So PP account debit to bank. Whatever monthly lease rent he pays, rather each month. No adjustment needs to be made here. This will straight away off to PRL. But now that you capitalized your asset, which has a life of 60 months, 5 years, either way, ultimate impact on P&L account is same only, but there the lease rent per se got affected in scenario A. In scenario B, the lease rent is intact. Depreciation extra you have to provide. Net impact is same only, either way. So guys, I guess that's all with your additional questions that are taken in the Ind As 116 standard. Whatever COVID-19 relief provisions are there, they are now removed, sir, because that period got over. So barring to that, Ind As 116, there are no further additions, at least as of now.